This week on Wealth Track, preventing financial fires before they start and avoiding them if they flare up. Former IMF leader and financial thought leader John Lipsky joins global strategist Nick Sargent to discuss global hotspots, Europe, China, and the U.S. Next on Consuelo Mack Wealth Track.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Hello, I'm Consuelo Mack. I want to tell you about a new opportunity to watch Consuelo Mack Wealth Track before the program appears on public television. As a subscriber, you can see programs 48 hours in advance of the general public and also find timely interviews and commentaries exclusive to Wealth Track Premium subscribers. Next week, we tackle the topic of the lack of investor confidence and trust in the markets with Morgan Stanley's chief investment strategist, David Darst. If you're interested, just go to wealthtrack.com for more information. Thank you. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. It has been 4 years since the start of the worst financial crisis in the post-war era. It feels like a lifetime to me. Lehman Brothers filed for bankruptcy in September of 2008, tipping the world into a systemic financial meltdown, which we have been recovering from ever since. It's helpful to step back every once in a while and see how far we have come since the market lows of March 2009, when the S&P closed under 700. It has more than doubled since then, but oh, what a ride it has been. One of this week's guests, Fort Washington Investments' Nick Sargent, points out that there have been 3 distinct market phases since the financial crisis began. First, the sell-off from September of 2008 to March of 2009, when global credit markets froze, economies fell into recession, and the Fed drove interest rates to zero. During the sell-off, the S&P lost 46%, other markets plummeted, U.S. Treasuries and gold were the only major asset classes to gain. The second phase is what Sargent calls the rally rebound. Monetary and fiscal stimulus continued, banks stabilized, and economies started to recover. From March of 2009 to March of 2010, the S&P skyrocketed 76%. Other stock markets soared, as did high-yield bonds. The third phase is what we have been living through since, what Sargent terms choppy, the infamous risk-on, risk-off market buffeted by the onset of the Greek debt crisis, which has spread to other countries and brought the viability of the entire Eurozone into question. Stock markets, especially in the U.S., have actually done better than they feel through this period, and bonds, especially high-yield ones, have more than held their own. So where do we go from here? Our 2 guests have followed every twist and turn of the financial crisis and its aftermath. One is an investment strategist, the other is a major player in global finance. Nick Sargent is a familiar face on Wealth Track. He is Chief Investment Officer of Fort Washington Investment Advisors. Nick is a longtime international economist and global money manager who has had top positions at major Wall Street firms, including Salomon Brothers and J.P. Morgan Chase. He also has a PhD in economics from Stanford. Our second guest is a new face on Wealth Track, but is well known and highly respected among global policy and financial leaders. He is John Lipsky, Distinguished Visiting Scholar at the Johns Hopkins University School of Advanced International Studies. Late last year, John retired from the International Monetary Fund, where he served throughout the financial crisis from 2006 to 2011. John was the IMF's first deputy managing director and became its acting director when Dominique Strauss-Kahn resigned in 2011. Among the senior positions John held prior to the IMF was chief economist and director of research at J.P. Morgan and chief economist at Salomon Brothers. He also has a PhD in economics from Stanford. Needless to say, Nick and John have known each other and worked on and off together for 40 years. I began the interview by asking John Lipsky about Fed policy and how much impact additional stimulus would have.
The question is, do they have tools that could produce a big impact? Interest rates are already at zero, their interest rates, and long-term interest rates are at historic lows. So they're talking about some kind of quantitative effort, purchasing securities, et cetera. And it's unlikely that those, what they're contemplating would make a large difference in the economy.
Nick, the
Yes.
markets pay attention to every utterance from the Fed, every
Absolutely.
interpretation of what the Fed might do. So what difference do you think whatever policy the Fed could take now would make?
I'd agree with John. Very little difference to the economy. And he mentioned interest rates record low. I'd add banks sitting on record excess reserves. So when they do this, they're creating more excess reserves. So the old adage, pushing on a string. But the weird thing about markets is they clearly want the Fed to do something. Don't just stand there, do something. This has been an unusual stealth rally in the past couple of months. And the only explanation I have is, again, the markets hoping that the Fed will do something. And so I think they will, but at the same time, I do think it will have limited impact.
So John, let me ask you about where we are as far as policy in general around the world. Policymakers have been extremely active throughout the financial crisis and through the recovery. So what's your view of the importance of policy? I mean, what kind of ammunition do policymakers have left, whether it's politicians or Fed and monetary policymakers?
Well, first of all, on the monetary side, we're in a period of unprecedented monetary expansion. Policymakers in the principal economies are generally at zero interest rates or something very close. They're pushing virtually as hard as they can. And I think that has been helpful for sure. Again, the question is how much more can they do? They certainly wouldn't want to give the impression that they're at the end of their tether, but no one thinks that monetary policy is going to be decisive. At the same time, in response to the crisis, fiscal debts, budgetary debts and deficits have built up to huge levels, unprecedented levels in the industrial economies, and there's a recognition that we need in the short term some sensitive turn towards medium-term discipline and reduction in deficits and eventually in debt burdens. This is requiring a fair amount of sensitivity on the part of authorities around the world. I'm sure we'll talk about Europe in more detail where the challenges are much more elemental. So markets and investors really are looking to policymakers for their agility at a time in which the challenges are large.
And how important is it, Nick, as far as investor confidence is concerned and the direction of the market?
Policy matters, and again, it depends where you are in the cycle. I believe the Fed's actions after Lehman Brothers was the single most important thing to stabilize the financial markets. And that
Massive stimulus, massive
That's right.
easing.
So I was in favor of quantitative easing in that initial round. I think what we're saying is, though, as the conditions now in the financial system have stabilized, then it's at the margin, how much more difference does it make? And I think that the evidence suggests it's not going to make a big deal of difference. But in the short run, and I have to make investment decisions in the short run as well as long run, there's no doubt that the market feels better that the Fed will be doing some additional action. I just think in this case, that good news is now priced in, fully priced into the market. So I don't expect it to go higher once the Fed does launch the latest initiative.
All right. John, you alluded to Europe. You've just spent the last 6 years of your life basically saving the financial world at the IMF. So, and thank you for your service. How much has it improved? When I'm looking at the integrity of the financial system, the viability of the financial system, what gives you the most confidence? What's gotten really better?
There has been a big action on the official side. If we look back to the crisis and look at the reactions, big steps have been taken. Regulatory and other reforms around the world, coordinated through the Financial Stability Board, new measures of assessment of the problems through the IMF's Financial Sector Assessment Program, big actions. The financial institutions themselves, banks, recapitalizing, improving their own operations. So a lot that's positive has been undertaken, but there's still a long way to go before the process of restoring the stability and full effectiveness of the financial system can be decreed to have been achieved.
So what are you most concerned about going forward?
In the context of the financial sector, first of all, the the European banking system needs to be stabilized and fortified. The European authorities are now on the verge of agreeing some very historic steps, so-called banking union in Europe, creating what they call the European Stability Mechanism that is able to invest directly in bank capital, a kind of a Euro TARP. These will be very, very, very big steps and are very important.
So are you confident that those steps will actually occur?
My impression is that the European authorities recognize the need for these very difficult but very fundamental steps, and I'm confident they will be undertaken. It's not going to be like a light switch. This is going to be a process, but I'm confident we're on the way.
So Nick, how confident are you, number one, about the viability of the financial system,
Yes.
how well it's healed?
I think that in the case of the United States, when the U.S. banks were able to pass those stress tests in 2009, that was again a game changer for us. So as John was alluding, though in Europe, they didn't recapitalize their banks as they should have. And so I think that the moment of truth was really in May, June, when would Greece be forced to exit or would they opt out? And you had the problems in the Spanish banking system. And so everybody was worried if there's a run on the Greek banks, does it spill over to Spain and Italy? And those are much bigger players.
And it definitely had.
That was the fear. And I believe that, as John was alluding, that the European summit then said, okay, this is the moment of truth, and they did announce some measures that will recapitalize the banking system, and that will give more authority, we believe, to the European Central Bank in monitoring these developments.
So they'll become like the Fed and the Treasury. They'll be able to directly help banks instead of having to go through the various governments.
Exactly. So if you like, how does that affect me as an investor?
Right.
Okay, as we're saying, who knows how it will play out? I'm less concerned about Lehman II happening in Europe. And that was a fear that we could see the unraveling of Europe's financial system. So I think that risk has diminished. The but is, I tell people, but we're not completely out of the woods in the sense that we're still going to face challenges. You've talked about the choppy markets. Well, right now people are feeling a little bit better, but I say, you know what, I think there's still going to be further tests ahead, so I don't want to get carried away and too optimistic we've solved Europe's problems.
Because it seems that there is an emergency du jour, and you know, you said that there are moments of crisis, yes. But it strikes me that Greece is an ongoing crisis. So John, I mean, you know, what are the chances of Greece exiting the Eurozone, and does it matter?
Well,
or the euro. Right.
First, we need to keep it in perspective. Greece is about 2% or less than 2% of the GDP of the Eurozone. Obviously, you have to solve the situation of Greece one way or another. But the decisive issue is, first, to stabilize the financial system, to strengthen the financial system, and to create the governance mechanisms going forward, like a European banking union, like Central European institutions that can deal with these kind of problems in the future, that will give confidence, not that everything's been solved by a decision at a summit on one day, but that a process and a commitment, backed by a political commitment to deal with the underlying issues in a convincing way is what's important.
And you think that's happening?
So far, every time we've come up to these kind of crises, the decisions have been taken to keep moving in a forward way. And the latest set of decisions, if they're implemented as described, would be very, very important.
All right, so these incremental steps, but it's going in the right direction. So Nick, your job at Fort Washington is to advise clients is how to invest no matter what happens out there. So what are you telling them? What's your strategy advice to them?
Well, we're doing two things differently than what we had done previously. I think number one is be more eager to take profits when we see outsized gains. So if we didn't expect, say this year, you know, the market's up double digit. I didn't expect to see this. Hey, I don't have to eliminate all positions, but let's take some profits. And if I'm correct and the market retraces, I can reinstate that. So we're doing a little bit more trading activity than in a clear trending market. You know, the second thing is strategies in the stock market. I'll use the example. We're predominantly at Fort Washington a value-based investor. We do have some growth portfolios, but heretofore, up to 2 years ago, we didn't have a dedicated dividend portfolio strategy. And we said record low interest rates, people want stability.
And
makes
income.
some sense. So, and income. So we created for our parent a dividend portfolio to complement our value strategies. So what that's basically saying is there will be periods where the dividend portfolio will outperform as it has, but there may be periods where if people say, no, we're past the worst, these value or cheaper stocks will do better. So we're combining it rather than saying put all your eggs in one style.
So, John, let me ask you one more question about the Eurozone, and that is, again, it's moving markets on a daily basis. It seems to be this stop-start. I know it's very complicated. There are 17 countries involved, 17 different governments change. But do you feel that the Eurozone is basically, it's economically, it will start growing again, that in fact that they will get their act together, that it's possible to have a political and fiscal and monetary union? I mean, is this really realistic?
Well, Consuelo, that's a very simple question.
Yeah, I know,
It
sorry.
lends itself
Right.
to a very quick answer. I'm an optimist about the medium-term outlook in Europe and about the commitment and recognition of both European governments and European citizens about the need to continue to construct an effective, efficient European-scale economy.
Why?
And European
What's in it?
scale,
Why do you think that the man on the street, for instance, buys into this union?
the recognition that Europe, in essence, today is on its own, or each country on its own, is relatively small and relatively isolated. And in a world dominated by growing large-scale markets, that they need to achieve the efficiencies and effectiveness that the United States appears to have. Growing powers like China and elsewhere are developing, and they need, for their own purposes, to create this European economy. There are many roads to it, but they've chosen a road, not an easy one, and I think they will carry it through. Now, from the short run, we can see that the European economy is basically in recession. And there's a little optimism that although it's generally felt that the policies they're putting in place will produce some growth in the next few years, no one is really looking for strong growth in the Eurozone. So here, I think from an investor point of view, the question is really, will they avoid creating damage to the rest of the world economy?
Right.
Could there be some instability through a breakup of the zone or things like this that investors worry about that could have spillover effects and destabilizing effects elsewhere? So
Those are great questions.
well, I think
answer them.
I think I've given my answer, but hopefully it's clear. This will not be solved instantly. There's
Right.
not going to be able to wake up one morning and say, "Oh, I'm glad that's over." But it strikes me that you can have medium-term confidence that they're going to continue to do the right things that will preserve the stability and ultimately produce an effective European economy and stable European markets.
So we better get used to, though,
Yes.
this uncertainty. So that means volatility in the markets.
Correct.
And as far as what are the other hotspots? I mean, China. A lot of
Yes.
people are saying that China.
Yes.
Is it hard landing? Is it soft landing?
Yes.
What do you think it's going to be, and how important is that for us as investors?
Well, for me. So, Consuelo, I did some research on that. I'm continually monitoring it. But here, my tentative conclusions are, what I know so far in terms of the data that have been reported is I'm feeling better that this isn't the bursting of the bubble, that let's say growth goes from 10% down to 4 or 5, as a Barron's article recently questioned. I think probably 7% or so. And somebody says, well, that looks very good, but that is a deceleration.
Sure is.
So we're feeling the effect. Where I'm coming out, though, I think, and this is the longer term call, I followed Japan when it was at double digits in the 1970s, and then at some point it began to downshift to more sustainable pace. So my expectation is in China, we're starting to see the beginning of that downshift from double digit to 7 to 8%. It's not the end of the world. In fact, Chinese policymakers probably say, that makes sense to them.
So that's more of a softer deceleration.
That's right. There will be ramifications. China's been a major driver in the commodity markets and the like, and that's why we've seen this volatility in commodities. I'm in the camp of there is a definite slowdown. I think it will be a development, but I don't believe that I'm going to be seeing an immediate bursting of the Chinese bubble at this time. And that gives me some confidence that the markets aren't going to really swoon on us.
Mm-hmm.
John, China?
Yeah, let me add just a word on China. Last year, the Chinese authorities promulgated their 12th five-year plan. And if you read through that five-year plan, I think most investors would find that very congenial. A series of liberalizations, of refocusing the economy on the domestic markets, boosting domestic demand, especially consumer demand, creating social safety nets, strengthening the financial system, on and on. I think you'd read down that list and say yes, 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 yes. The question is, will it get done? Because when you look at the 11th five-year plan, you can see many of the elements were contained there that were not carried through. But there's a major change of government coming in the next few months. So the question of consequence in China, there's a plan that I think most everyone thinks is an excellent plan. Will the authorities be able to implement that plan in a convincing way? If it will, I think we're all convinced that China will be a strong and increasingly reliable source of strength for the global economy, not instability. So the next year will be very important and very interesting to see which way is China going.
End of every Wealth Track, we ask our guests one investment for a long-term diversified portfolio. You come from a value shop at Port Washington, Nick Sargent, so what would it be?
I'll stick my neck out a little bit. It might be an early call, but I do believe we've done our homework. We've begun to make some forays into the European markets, mainly in the safer sectors, not financials, maybe telecom space and the like. So I do believe what I'm basically saying is this could be a mega trend, but I'm going to listen to John Lipsky. If if he grows more confident that we've turned the corner, I'd be adding to positions in high-quality European names at this time.
All right. And John, you don't give investment advice.
No.
But nonetheless, one thing that you told me is that basically don't sell the U.S. short. Why are you optimistic about the U.S.?
I am optimistic about the outlook for the U.S. economy for a number of reasons. For one, not sure that everyone has taken on board the implications of the change in the energy market in the U.S., not just a supply of cheap natural gas relative to the rest of the world, but also the increase in the production of petroleum here in the United States. Secondly, the U.S., if we look at why are things so sluggish, frankly, corporate spending on plant and equipment has been relatively strong, reflecting good profitability, good productivity gains. And so there's no reason to think that that's a source of problem. Corporations are very cash rich, but the housing sector, where new unit construction is far below what you think of as trend household formation rates. When you look at autos, the current sales rate means that the average age of the auto stock is still going up. You think, well, there's room for improvement just in let's call it a kind of organic sense if people regain their confidence about the outlook. Add to that the possibility, it's conventional, it's very common to say, oh, gridlock in Washington, they're not getting anything done. Think of the possibility that they will take steps after the election that will give more confidence that things are headed in a positive direction. Once again, not to solve everything at once, but they don't have to solve everything at once. Put those all together and you have a set of, not forget the financial sector in the U.S. that has really taken a lot of steps to recapitalize and stabilize. You put those all together and you end up with a fairly favorable, I think, relatively favorable outlook for the U.S. It could be quite favorable.
I feel so much better having talked to both of you. I cannot begin to tell you, as I'm sure our viewers will as well. So John Lipsky, what a treat to have you on Wealth Track. I hope you'll come back again.
Thanks so very much.
We love talking to you, and with your very good friend Nick Sargent from Port Washington Investment Advisors. Thanks so much to both of you for being on Wealth Track. Incidentally, we will have an extended one-on-one interview with John Lipsky about the financial crisis and the Eurozone on our website, wealthtrack.com, starting this weekend. Well, this week's Action Point picks up on our guest's guardedly optimistic views on Europe and follows investment legend Sir John Templeton's advice to buy at points of maximum pessimism. Investment attitudes towards European stocks veer between pessimism and despair these days. So this week's Action Point is consider high-quality European stocks. One of Morningstar's favorite European stock mutual funds is Mutual European Z, which has been run by WealthTrack guest Philippe Brugier-Trollat since 2004 and has an outstanding track record. Next week, we tackle the topic of the lack of investor confidence and trust in the markets with Morgan Stanley's chief investment strategist, David Darst. If you would like to watch our extended interview with John Lipsky or our other guests, please go to our website, wealthtrack.com. It will be available as a WealthTrack Extra. Thank you for watching. Have a great weekend and make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. And Tocqueville Asset Management, contrarian investors combining independent thought with in-depth research.